more knowledge you have, the better you'll invest. The better you invest, the higher your returns will be. The higher your returns, the larger your wealth will be in the future. The larger your future wealth, the greater your chances of building passive income and seeing dividends land in your account every month to cover your bills. But all of this has one single starting point: knowledge. That's why in today's video, I'll bring you a lot of knowledge. I'm going to share 5 unfailing tips for you to make money in the stock market. And here's what I did: invested in knowledge, then transformed that knowledge into learning, then converted learning into returns, and finally turned returns into money. That's exactly what I'm going to help you do today. So before anything else, don't forget to like and subscribe. Let's dive in. First tip, be careful when turning the coin. Imagine I invite you to play heads or tails. If it's heads, you win $100. If it's tails, you lose $100. Would you play or not? Leave it in the comments. What's the idea behind this game? There's an economist named Daniel Kahneman who created something called prospect theory. Prospect theory explains that human beings feel much more pain losing $100 than pleasure from winning $100. You'd prefer not to risk losing $100, even if it means missing out on potentially winning $100. Your perception of value is stronger when it comes to losses than gains. Sure, winning $100 will make you happy, but losing $100 will hurt much more. Here's the thing: many people will choose to play. Many others will refuse. But the people who lose the $100 will feel the loss more intensely than those who win the $100. Let me give you another example. Imagine you have a $100 bill in your wallet, and I offer you another coin toss. If it's heads, you double your money to $200. If it's tails, you lose everything. But here's the catch: this coin is biased. 90% of the time, it lands on heads. So your chances of winning are significantly higher than losing. Would you play, or would you prefer not to risk it? Many people still won't play, and many others will let greed take over, deciding to flip that coin multiple times. The problem? A coin biased at 90% isn't 100%. Eventually, it will land on tails, and you'll lose everything. The same thing happens in the stock market. Imagine this scenario. The market is going up like crazy. Everyone around you is making money. Suddenly, a crisis hits and the market begins to crash. People panic and sell at any price. Those who got greedy lose their money. So here's tip number 1. Be careful flipping the coin. The market can look favorable. The economy can feel strong. Everything might seem to be going perfectly. But if you let greed take control, you're going to lose money. Well, moving to tip number 2, buy Bitcoin. In 1970, buying a home cost roughly 2 years of an average salary. Today, that same home costs around 6 years of income. Why? Because since leaving the gold standard in 1971, the US dollar has lost around 97% of its purchasing power. This means your money today buys much less than it used to. Everything from housing to education and healthcare has become dramatically more expensive. Bitcoin flips this script. Unlike the dollar, Bitcoin is capped at 21 million coins, making it deflationary by design. Its limited supply, combined with growing global demand, pushes its intrinsic value steadily upward. Financial giants like BlackRock and Fidelity, and even countries like El Salvador, are investing heavily, further boosting its legitimacy and value. You don't need a fortune to start. 0.1 Bitcoin currently costs around $10,000, but this value fluctuates, presenting buying opportunities. Bitcoin breaks down into tiny units called satoshis, letting you buy fractions at your own pace. Why should you care? Because Bitcoin shares features with the world's most reliable assets: scarcity like gold, consistent appreciation potential like real estate, and long-term growth akin to solid stocks. Plus, it's easily stored, divisible, and accessible worldwide. If you hold Bitcoin over time, its rising purchasing power means your everyday costs, food, fuel, healthcare, effectively decrease when measured in Bitcoin. This is not theoretical. It's happening right now in high inflation countries, demonstrating Bitcoin's real-world power to protect and even boost purchasing power. Analysts foresee significant price growth, potentially reaching $200,000 in 2025. So even owning just 0.1 Bitcoin could substantially improve your financial security and lifestyle. Bottom line, having at least a small fraction of Bitcoin isn't just smart, it might be essential. If you put everything in Bitcoin, I think you're crazy. But if you don't even have 1%, you're crazy too. Bitcoin is a convex asset. Convex assets are investments that have the characteristic of having limited losses, but the potential for unlimited gains. In other words, convexity means that the risk and return curve has a concave shape, where the risk is greater when the investment is low, but the potential return is greater when the investment is high. You can only lose 100% of your money with Bitcoin, but it is impossible to predict how much you can earn. So that's tip number 2, buy Bitcoin. Well, moving to tip number 3, be on the right curve. This tip comes straight from Howard Marks. He's one of the greatest investors of recent times, so much so that Warren Buffett himself once said, whenever Howard Marks releases a memo, he stops everything everything to read it. One of the most valuable things Howard Marks taught me is that few things in life move in a straight line, especially in investing. Instead, things move in cycles of expansion and contraction. Usually, the stock market cycles look something like this. Phase 1, optimism. Interest rates drop, taxes decrease, government spending increases, the economy booms. Phase 2, euphoria. Economy runs at full speed. Unemployment drops to very low levels. New businesses and startups emerge, stock prices skyrocket, increased demand triggers inflation, leading to the next phase. Phase 3, contraction. Government raises interest rates to control inflation. Consumers cut spending due to higher interest rates. They prefer to invest rather than spend. Stocks begin to correct. Phase 4, depression. Economy slows down significantly. Consumer spending drops sharply. Unemployment rises. Companies' price to earnings, PEE, ratios shrink rapidly. People think the market has reached its end. Eventually, the economy recovers and the cycle repeats itself. Howard Marks developed a checklist to help investors analyze and recognize exactly which phase of the cycle they're in. Buffett himself famously said, "The less prudently others manage their affairs, the more prudently we must manage our own. When others are careless, we must be cautious. When others are fearful, we should become aggressive. To make money, you must think counter-cyclically. And to think counter-cyclically, you must be on the right curve." That's tip number 3. Well, now tip 4, develop market superpowers. According to Morgan Housel, there are several essential skills when investing, but 5 of them stand out as superpowers. First, low sensitivity to FOMO. FOMO means fear of missing out. You know, when your friend says, "Dude, I bought this stock earlier this year and it's already up 100%. I'm making a ton of money." What happens next? You get jealous and immediately jump in to buy. Buying something impulsively, that's FOMO. So the first superpower is resisting the temptation of FOMO. Second, know the game you're playing. According to Morgan Housel, there are many types of investors in the market. Long-term investors, short-term investors, dividend investors, capital gains investors, institutional investors managing billions, retail investors starting small. If you wake up tomorrow, open your brokerage app and see a stock in your portfolio dropping, it might feel important, but usually it isn't. Most times, price fluctuations happen because someone else is playing a different game than you. There's no need to worry about them. Third, have a long-term horizon. When investing, you must outperform most people if you want better than average results. So what's your advantage over others? Maybe you have better technical knowledge. Perhaps you analyze certain companies better. Maybe you're more rational and make smarter decisions. Or maybe you're simply more patient. A single $1,000 investment could become $300,000 over time. If you invest with your children's future in mind, that $1,000 could become millions, providing for multiple generations. That's the patience game. Long-term investing. Fourth, understand the difference between patience and stubbornness. Think about it. Investing long-term doesn't help if your strategy is flawed. Technical investment details are constantly changing. Which sectors will perform best over the next decade? What type of company benefits most from today's macroeconomic scenario? Which sectors rise more as interest rates fall? These specifics change over time. What never changes? The way people think, behave, and react to fear and greed. Most people focus exclusively on technical details. You need to combine technical details with understanding human psychology. As Morgan Housel says, the economy is always changing, but human behavior never does. Fifth, being comfortable during adversity. Every good investor needs calm during the stock market's most chaotic moments. You develop this over time through market experience, but it's never easy staying calm when your portfolio drops 50% in 1 month. The question you must ask is, have the fundamentals changed? If fundamentals haven't changed and the drop is temporary, you might be looking at the opportunity of a lifetime. You just don't see it clearly yet. Now let's move on to the final foolproof tip to make money in the stock market. That's tip 5. Know how to manage the rabbits and turtles. Florin Bartunek, manager at Constellation, uses an analogy involving rabbits and turtles to explain diversification. If you have 5 rabbits, they run fast, but you can easily manage all of them. If you have 50 turtles, despite moving slowly, you'll inevitably lose track of some. Similarly, some investors have small portfolios but hold too many stocks, like having $1,000 spread across 50 stocks. Others invest millions, yet have only 10 carefully chosen stocks. Regardless of your portfolio size, fewer stocks allow deeper understanding and clearer risk assessment. Research supports this. Diversification effectively reduces risk, but only up to a point. Studies show that adding more than 20 stocks to a portfolio provides minimal additional risk reduction. The first 20 stocks significantly reduce your investment risk. Beyond that, the benefits sharply diminish. However, true diversification isn't just about quantity, but quality and variety. You must diversify across different sectors, countries, and asset classes. Owning 10 stocks from one industry isn't true diversification. Remember, diversification should balance risk reduction and potential for gains. Owning too many stocks dilutes the impact of significant gains. As Warren Buffett once said, wide diversification is only required when investors do not understand what they are doing. That's it, cousins. These 5 tips can help you earn more money in the stock market. I'll see you in the next video. Take care.